To break down those numbers in a CNBC exclusive, Citizens Financial Group Chairman and CEO Bruce Van Saun. Bruce, thanks for being here. So as I mentioned, there's a lot of noise this quarter in terms of profits. So I want to focus first on NII, net interest income. That's the profitability metric from loan making. You gave some guidance there. You're expecting declines up to 9% for the full year 2024. Do you see it troughing this year if we get 6 rate cuts as the swaps market is predicting?
Yeah, so I would say one thing that's very positive in the fourth quarter is that we're starting to see less pressure on our funding costs. So as the Fed raised rates very aggressively, funding costs went up. The bank failures didn't help that. But our net interest income was down 4% sequentially in Q3. It's only down 2% in the fourth quarter. And then kind of next year, we have the full year effect of some of the things that have happened in 23. But we see an inflection point actually halfway through the year that we should start to see net interest income tick up. We expect economic activity to pick up, and therefore loan growth will tick up. So I think a couple more quarters of hanging in there, and then things should start to brighten in the second half of the year.
Can you help explain that to our audience a bit? Because for much of 2023, rising interest rates was a tailwind for net interest income. It was supportive because banks were able to lend out at higher rates, and they weren't quite needing to pay up for those deposit costs, at least in the first half of the year, as much known as deposit betas. When I look ahead to next year, at least if you kind of go with what the swaps market is indicating, by the middle of the year, that would indicate we start to kind of reverse that and see some lower interest rates. So how does that provide a tailwind to NII in terms of its ability to trough, at least in the middle of the year?
It's a little complicated, so I'll try to keep it simple. But when rates are going up, in the beginning, banks are what's called asset sensitive because their loans are repricing instantaneously, and banks can lag their deposit repricing. As you get farther into the cycle, once the Fed stopped in July, your loans aren't repricing anymore, but there's still increasing pressure on your deposit costs. So that will continue to impact the first half of the year. Kind of once rates go down, we have certain swap positions on that are costing us money today, will cost us less as rates go down. And then volume kicking in, having loan growth going up, that's the other factor in terms of a determinant for your net interest income. So a little bit will benefit, from the swap drag going down, but then the volume kicks in the second half of the year.
Right. That makes sense. Speaking of, the asset side of your business, credit quality, you set aside more in provisions during the quarter. You said on the call this morning that CRE General Office is being carefully managed. Losses are being absorbed in net charge-offs with few surprises so far. But with record real estate debt set to come due this year, I have to wonder, given that we're still in a relatively high interest rate environment, what are your expectations for defaults, across the sector and specifically for Citizens?
Yeah, so I would say if you look broadly across all of our lending portfolios, feel really good about the consumer portfolios. We tend to lend to the more affluent customers, and they're still in really good shape. Feel really good about commercial lending. Most companies navigated the pandemic well. They had good years. They're positioned. I think they're cautious for next year, but they're positioned to be successful, and we won't have a lot of charge-offs there. It's really, as you say, commercial real estate that's been the main focal point in terms of potential losses. And it's a subset of commercial real estate because broadly, other areas, multifamily and industrial distribution space, that's doing fine. It's the office and these return to office trends that have really turned that market kind of upside down in terms of not having the best dynamics. The good news is we can see what's happening in those portfolios. We can see when maturities are coming due. We have a lot of great workout people in the bank who are working with those borrowers to try to figure out how to come up with solutions where we might take a charge off. The borrower may put in some additional money. They live to see another day. And so that's been a process that we've basically managed through in 23. We're going to continue to manage through in 24. I actually think it'll extend into 25. rates coming down will help that a little bit, but my plea to people watching is get back to the office. It would really help the commercial real estate sector.